The Q1 2026 earnings season is officially underway, and the initial data points to a market struggling with profound structural instability. Even so, we are maintaining our year-end forecast for the S&P 500 at 7,200 points. That bullish target now sits in direct opposition to a geopolitical landscape defined by aggressive input cost inflation. At the consumer level, gasoline prices pushing past $4 a gallon are actively stalling discretionary spending and retail growth. Beneath the surface of these consumer pressures, the private credit market is beginning to signal systemic risk, with rising default threats across high-leverage portfolios. On one side of the screen, the index is mathematically tracking towards 7,200. On the other, Brent crude is holding above $110, cyclical earnings are being revised downward, and private credit is showing its first major cracks. Reconciling these two realities requires a deep audit of the EPS data, the credit risks embedded in the AI buildout, and the significant contraction in PE multiples. For corporate finance leaders, navigating this environment requires looking past headline index stability to dissect the underlying K-shaped forces driving this quarter. Current projections from LSEG show S&P 500 companies holding on to a strong 14.4% year-over-year growth rate for earnings per share. However, that top-line number is a statistical mask for a profoundly K-shaped economy. This waterfall chart isolates the drivers. The information technology sector's earnings estimates have been revised upward from 35.8% to 46.3%. The IT sector is now providing 10.8 percentage points of the entire index's growth. Meanwhile, the cyclical sectors are losing air. Consumer discretionary growth estimates have dropped to 1.9%, matched by a similar fall in consumer staples. This pressure is largely the result of a de facto blockade in the Strait of Hormuz, which has kept Brent crude oil pinned above $110 per barrel. This Hormuz tax creates a persisting pipeline of input cost inflation that radiates through global maritime shipping routes. In heavy manufacturing, this tax manifests as surging prices for industrial metals, such as the aluminum ingots shown here, as well as petrochemical feedstocks. The automotive sector is similarly exposed, facing failing costs for the essential chemical components that drive modern production. Management must now decide whether to absorb these costs at the expense of profit margins or test the pricing power of an already exhausted consumer. Analysts heading into Q1 calls will likely penalize any middle-market company unable to pass these logistics costs through to their end users. Beyond the public markets, a systemic risk is developing within the $2.2 trillion private credit market. Global demand for AI hardware and infrastructure remains high, driving record investment into data centers. Yet, as this infrastructure expands, it is simultaneously rendering legacy software business models obsolete. This graph illustrates the exposure. Private credit providers are heavily tied to legacy software-as-a-service companies that are now facing total disruption. As specialized AI capabilities spread, customers are migrating away from legacy SaaS platforms, severing the recurring revenue streams that back this debt. When these recurring revenues stall, the underlying debt becomes increasingly difficult to service. This leads to immediate credit deterioration and rising default rates within the private credit portfolios that have funded these distressed software assets. Financial institutions will be forced to address their exposure to these failing SaaS models in their upcoming management commentary. AI infrastructure is generating historic growth for hardware providers, while simultaneously accelerating the insolvency of leveraged legacy platforms. If margins are being squeezed by $110 oil and credit is tightening, the 7,200 index target seems mathematically out of reach. However, the market has undergone a significant valuation reset that provides a much firmer floor for the S&P 500. Over the last 2 quarters, the data shows that the period of extreme market overvaluation has ended. The S&P 500 forward price-to-earnings ratio has cooled from its October peak of 23.3x down to 19.4x. This cooling is most evident when we look specifically at the information technology sector. The IT sector's forward PE has dropped from 31.8x down to 20.9x, a very significant contraction. This 20.9x multiple matches the IT sector's lowest valuation level since January 2023, effectively resetting the cost of tech growth. Because multiples have already compressed to these levels, the index is no longer relying on speculative expansion to reach its targets. With valuations having reset to these historical baselines, the index can move towards 7,200 based on organic earnings expansion. even if that expansion is concentrated in high-margin AI and energy sectors. Capital positioning for the Q1 season must account for this volatility. Success depends on a strict division between companies with structural moats and those directly exposed to input cost shocks. For investors, this means moving capital away from cyclical middle-market stocks. Avoid the margin takers who lack the leverage to offset $110 oil. Instead, overweight sectors with structural pricing power, AI hardware infrastructure, domestic North American energy, and defense. Corporate treasurers should focus on auditing their vendor supply chains, specifically regarding tech debt. Ensure that critical software providers are not over-leveraged with private credit debt that could trigger a service disruption as AI adoption grows. Finally, do not chase short-term rallies driven by single-company earnings beats. The macro environment remains fragile. Utilize short-duration fixed income and USD-backed stablecoins to manage your treasury. This strategy captures high yields while keeping capital liquid and ready for deployment. Maintaining liquidity now allows institutions to capture the move to 7,200 as soon as the current geopolitical risk premiums begin to subside.